And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is a very special guest, Mr. Jim O'Shaughnessy, Chairman and Co-Chief Investment Officer at O'Shaughnessy Asset Management, with approximately $4 billion in assets under management. Jim, welcome to the show.
Thanks for having me, Adam.
Thank you for being here. So Jim, I always like to begin. Can you tell us your story on how you got started in the business?
It's a long one, so I'll keep it brief. I was fascinated by the stock market as a young guy. I just, I would hear my dad and my uncles arguing about it, and I would sit there and listen to them, and it was all talking about people, right? It was always the CEO says this, or I think their CFO is this. And I just kind of like wondered, I wonder if it would be more efficacious to look at, kind of the underlying characteristics of the stock itself, right?
Right.
So back in the day, I'm 60. So for all you young uns out there, we actually had to use paper spreadsheets.
Right.
So I went down to a research library. I grew up in St. Paul, Minnesota. So I went to the James J. Hill Library. I was very ambitious. I was going to do the S&P 500. And I'm also very lazy. So when I got there and I looked through the book, I'm like, no, this is never happening. So I did the 30 stocks in the Dow and did a lot of research on high PE, low PE, high div, low div. Anyway, ended up writing an article for Barron's on what's known now as the dogs of the Dow, buying stocks with the highest dividend yield. But I caught the desire to just know more, right? And one of my favorite writers is Dorothy Parker, who was a wit and a member of the New Yorker or the Algonquin Roundtable. She used to say, curiosity is the cure for boredom. There is no cure for curiosity.
Right.
So literally,
like
I just kept asking why. Very annoying. But that's how I kind of got to what works on Wall Street. And the quantitative methods that we use to this very day at OSAD.
I love it. So were your parent or your dad and uncle or the family members around you, were they in the business as well?
No, they weren't actually. So my grandfather was a very successful oil wildcatter.
Okay.
And he was one of the first to start the trend of giving virtually all of your money away before you died.
Oh, wow. That's great.
So amazingly proud of the fact that he did that. And the bit that he didn't get to before he died at age 88 in 1973 went into a foundation.
Okay.
And so the foundation would have quarterly meetings, and that's where they would be talking about the various stocks that the foundation was investing in.
Right.
The family business was oil. And, one of the reasons why I never encouraged any of my children to be interested in what I do was because I had the opposite. I had an uncle whom I loved. My Uncle John really wanted me to be in the oil business. And it took all of my powers of persuasion to convince him that that would be a disaster for both him and the company and me.
Right.
He finally relented. But anyway, that was the context of the conversations.
I love it. So were they managing money for the foundation, or was it more towards the lines of, oh, they were, okay.
No, they were the trustees.
Trustees.
And they outsourced, like many foundations do today. We manage money for foundations, for example.
Right.
And they were arguing about whichever portfolio manager had given them a presentation that day.
Yeah.
And it was kind of like, and not to throw my dad and uncle under the bus, because this was the 70s after all.
Understood.
Before we knew any of this stuff. But it was kind of like all the things that were wrong about the way to approach investing, right? Talk about the CEO rather than the underlying numbers.
Right.
Focus on the last 3 months as opposed to, the last 10 years.
Several years, right.
Focus on names like, ooh, that's a hot stock, versus process, right? Which is, the guy who came up with the idea of process in business, doing a process that is repeatable, Deming, said, if you can't explain what you do as a process, you don't know what you're doing.
Right.
So I learned quite a bit from them, but via negativia.
No, that's actually a common theme here I have on the show, because a lot of money managers that come on speak about their formative years and the lessons they've learned. And to me, it's fascinating because what you imprinted in you, whether consciously or unconsciously as a child, really resonates a lot of times as an adult. And it frames our thinking, whether negatively or positively, but it still has a big impact there until you get to an adult phase and then you drop it, so to speak, like Freud talked about. That's a whole nother story.
Yep.
Okay. So I love that, Jim, because you learned about what not to do, and then you took it upon yourself to discover what to actually do.
Yeah.
And that's a good segue to my next question. Can you please tell us a little about your investment strategy?
Sure. So OSAM uses a variety of models that we have tested rigorously over as much historical data as possible.
Mhm.
Often that goes all the way back to the 20s. And so we are obsessed with making our models better. So people always joke, well, you're a quant. What do you guys do all day? Golf? No.
Right.
We are actively, I put it this way, we research models the way more fundamental guys research stocks, right?
Understood.
So we're always trying to improve our methodology, but keep it absolutely in line with the foundational beliefs of the various models. So we manage strategies all the way from microcap to mega cap. And each of them have their own unique set of algorithms. And so what we believe is, find great investment strategies that work very well over time. That's the concept of base rates, right? So how often over any 1, 3, 5, 10-year period does this strategy beat its benchmark? By how much? That kind of is really interesting because we know kind of going in that a strategy doesn't work all the time.
Right.
You look at the 10-year base rate. So for some of our better strategies, there's still like a 5 to 10% chance that it's going to fail on a 10-year basis.
Right.
So it allows us a lot more flexibility because we are able to talk with clients about things that a more fundamental approach, just can't. Like, for example, before the great financial crisis, we were able to point to, look at the 70s. This thing went down 50%.
Right.
Can you handle that?
Right.
And then kind of religiously sticking with the process, right? Even when it's going against you, which is super hard, right? But I think that's one of the things that I'm most proud of at OSAM and in my other companies. We've never overridden a model, even during the great financial crisis. And we had a consultant come out and tell us, he worked for a sell side shop, and he covered quants. And I asked him how many quants overrode their models during the crisis. And he said more than 60%.
Wow.
And so, but to me, that is the death of your strategy's track record, right? Because if you're holding yourself out as dispassionate, as unwilling to emotionally override, and then you do it, well,
what's the point?
Yeah, exactly, right? Everything that went before is negated.
Right.
So we've never done that, luckily. And, it makes you very stoic, right? Because, I always joke that the 4 horsemen of the investment apocalypse are fear, greed, hope, and ignorance. And if you think about it, only ignorance is not an emotion.
Right.
Fear, greed, and hope have wiped out much more money of portfolio value than any bear market, because people, we're emotional creatures, and it just doesn't seem to change, right? We've known about behavioral bias and emotional biases and all these things for more than 100 years.
Yep.
I started looking it up in 1987 before behavioral bias was even a thing, right? It was
still there.
Yeah, it was back then called psychology, right?
Right.
So, but it's still there. And there's a really interesting, if you go to my Twitter account, my pinned tweet is a presentation I gave at Google Talks. And I also put up the deck that I used. And one of the academic papers that's in there is really interesting. Basically, these guys got the idea to study identical twins. And I think it was in Sweden. I could be wrong. but probably Sweden, because who else would have all the financial data
Why
that
not?
can
Yeah.
help with twins, right? So anyway, their conclusion was really quite stunning, which was 45 to 50% of your investment strategy or method is genetic and
Wow.
cannot be educated against.
Wow.
That's the part that's scary.
Wow.
Cannot be educated against.
Right.
And thus, it's like the Pogo cartoon. We've met the enemy and it's us.
I have a book coming out, Jim. It's called
Oh,
Psychological Analysis. And the whole premise is basically based on what you just said, how to remove emotions from the equation, make, rational, not emotional decisions, so on and so forth. So in addition to fundamental and technical analysis, I'm trying to develop this third school of thought for psychology, because that's really been front and center in my world for the last 20 plus years on my journey, which is nothing compared to yours, but has been my journey on Wall Street. And I've been fascinated by the ability and the inability for people to execute and actually achieve the returns that so few have been able to achieve. And my studies and my research has shown exactly what you're saying. Most people just can't do it.
yeah, it's a problem because when you look at the process that over time is very successful, it's simple, but it's not easy,
Right.
right? And so I often say that we arbitrage human nature.
I love that.
And it's kind of like the last sustainable edge, right? Because markets change second by second, but
Right.
human nature barely budges millennia by millennia.
Doesn't move.
And so I think that sometimes people think I'm kidding. Like I mentor some younger people in our business, and like they'll say, "What should I read?" And I'll say, "Understand evolutionary psychology and biology. You're going to be, and then history, and then philosophy,
Right.
and then read some finance."
Right.
And they're like, "Okay."
They don't get it. Right. They don't get it.
They do later.
Yeah, seriously. After they get, yeah, right. After they taste it, so to speak.
Exactly.
No, I love that. So I love your human arbitrage thing. I've got something called intellectual arbitrage and time arbitrage, which is a whole nother story, but I love what you're saying there.
Yeah, time
And
arbitrage is a good one too,
thank you.
because we have time arbitrage at OSAM because our view is we have a long term goal, and our clients understand that. And by the way, I should also say, I think that the best advice that I can give anyone who's watching this, right, is it doesn't have to be my strategy that you use. What you need to find is something that's right for you, right?
Right.
Because you can't like read What Works on Wall Street and say, I'm going to do that if you don't believe in it, right?
Yeah.
And if you don't tinker a little bit. So I often also say, for the majority of people, unless you just really love the market and stuff, indexes, man. I mean,
100%.
yeah, and then go on and enjoy the aspects of your life that are non-market related.
Right.
I talk to a lot of people who feel that they should be interested, but they're not. I'm
They're
like,
not.
you don't have to be interested.
It's okay.
It is, because this is kind of like a golden age, right? For investors,
Yeah.
zero transaction costs,
Yeah.
ETFs that cost a few basis points if they're not free.
Mhm.
Just if you
Fed's got rates at zero. Yeah, they're printing. Yeah.
if you're not interested, that's great.
Yeah.
Follow your passion in literature or music or art or whatever it is.
Right.
And dollar cost average into an index fund. Yeah, you're not going to have a great story at a cocktail party, but I always use that as, hey, that's good.
Break through yeah, exactly. You're going to have the returns, and that's what matters.
Exactly.
So no, Jim, I love this. So tell me a little about how you handle risk with your models, and what mistakes you see people make with respect to risk management.
So with all of our models, the risk metrics are baked right into the selection strategy. And let me give you an example. So during the Great Financial Crisis, if, say, you were just a simplistic deep value person, you would look and you would say, wow, Citigroup has like the third highest, I could be wrong on the number, but directionally this is correct, has like the third highest dividend yield in the S&P.
It went down to $1 in 2000. I remember that. Yeah.
Well, and that's kind of my point, right?
Yeah.
So we have a whole host of built-in metrics to tell us what stocks we shouldn't buy. So for example, Citigroup, we use what we call factor composites. So it's not just one factor, it's several.
Right.
And in this example, so Citi, to somebody who was a lover of dividend yield, they probably would have bought it, right? But we had one called financial strength and earnings quality. And oof.
Yeah, seriously.
Citi was a basket case on those. So it immediately got negated, right? So we use, as part of our ongoing risk assessment of stocks, we have certain groups of factors or composites that they're only there to push stocks out of our consideration, right? So we feel pretty lucky about that, in that it saves us from a lot of Citigroups in terms of that particular risk. We also have our sell discipline baked right into our process, right? Okay. So you often hear people having conversations about, many portfolio managers, they really know what stock to buy, but they're not so good at selling, right? And again, that's back to, I think, a behavioral bias. So we bake it right in. And so we get a weight of the evidence, right? And so our high conviction, right? It isn't our conviction, it's the conviction of the model. So if a stock, we use what we call an ongoing monthly rebalance, right? And so we rerun the models every month. If a stock shows up, we add to that position, and thus we can get up to, it's got to be 5% as our top, right, at purchase. But so if a stock keeps showing up, we keep adding to the position. On the other hand, if a stock no longer shows up, we start subtracting from the position. Interesting. And then finally, we work mostly directly with intermediaries, with advisors. So we don't do end client risk analysis, but we certainly do have some things that we suggest to our partners in terms of assessing somebody's real risk versus what they say they can take. Understood. My friend Jason Zweig, who is a columnist at the Wall Street Journal, has a great metaphor for this. He says most people think that they're doing risk measurement of a client, right, by showing them a picture of a snake. Right. He goes, what you really ought to do is throw a live snake in their lap. Seriously. Very different reactions. Total different reaction. No, I love that. So Jim, from your risk standpoint, I'm curious here. So 5% positions in your overall portfolio, and you'll add to it if it shows. At time of purchase, right? At time of purchase, right. Yeah, so when you add to it, do you allow it to go higher? We allow it to go higher after we've hit the 5% limit, right? Okay. So, but that's market appreciation. That isn't, okay. Yeah, that isn't us adding. Okay, got it. And then as far as risk from entry to exit, do you have stops like, okay, if it falls 10% below my entry price, I'll sell it, or 20% or some other levels, or how does that work? Yeah, so no, we don't. We tested that extensively on a variety of strategies. And, I'm going to get a lot of boos and hissing here, but that's okay. We want the truth. That's all we're looking for. Empirically, it doesn't work. So even if you put a wide stop of 20% below your entry or something along those lines, doesn't work? Especially if you are investing. So we do both value and growth, but our version of growth is momentum, right? Okay. Price momentum. I'll give you an example. So we have a strategy that invests in small to mid cap momentum stocks, right? Yeah. And when we were doing the testing for putting stops in place, basically it took us out of all the biggest winners in that portfolio year after year after year. Wow. Why? Because guess what? They're really volatile. Right. And they run up and they run down. And so we just, again, because we need evidence, when we ran the tests, just there was no efficacy in putting stops in place. Interesting. So what do you sell based on? In other words, you said you sell when it, yeah. So based on the model. right? So let's take our market leaders value, which is a large cap, high shareholder yield strategy, right?
Mhm.
Shareholder yield is dividend yield plus buyback.
Okay.
Okay. So if a company gets included in the model,
Mhm.
we keep buying it up to that 5% cap, right? But then as the model continues forward in time, and
Mhm.
by the way, anyone who wants to see this graphically, go to our website, www.osam.com.
Mhm.
Click on philosophy and process, and we've got some pretty cool graphs that
I
show how
love them
that
there, by the
works.
way. They are really cool.
Thank you.
Yeah.
So it just happens as part of the model, right? So if let's say stock XYZ, right,
Mhm.
got selected a lot and it was a fairly big position, but then it wasn't selected anymore. Little by little, we'd move out. Now we do have a series of what we call red flags that will have us liquidate an entire position.
Oh, wow.
And those are things like, fraud,
Yeah, of course. Yeah.
and, restatement of numbers such that it wouldn't have gotten in when
Beginning. Yeah.
we
Yeah.
ran it. And so those are there, but for the most part, just built right into the model, no longer meeting the criteria. We sell until it's no
Got it.
longer in the portfolio.
Makes sense. And then as far as profit targets on the way up, if that's selling on the way down, do you guys have arbitrary profit targets, or is it also? I didn't think so, but go ahead.
Yeah, no,
Yeah. Okay.
not at all. And again, forecasts, we've collected forecasts for a long time, right? And other people like Philip Tetlock have done it much better than us. David Dreaman, another one. They're worse than flipping a coin.
Yeah.
And that's all of us, by the way.
I couldn't agree more. I couldn't agree more.
And this falls under yet another behavioral bias, which is we as human beings, first off, we all have, to a degree greater or less, the same operating system, right?
Yep.
Human OS. And so people who think they're an exception to this are only fooling themselves.
Well, that's a
right?
personal blind spot bias, right? If you
Yeah.
ask 100 married people how many people get divorced, nobody's going to raise their hand. Statistically,
Ex-
half of them are getting divorced, right?
That's right.
Yeah.
And so the point is, though, another thing that we really crave as human beings is the illusion of control.
Yes.
And when that goes away, people get really freaked out.
Yes.
And so, I mean, witness the entire pandemic, right? And people arguing about masks, for God's sake, right?
Yeah.
Boom.
Yeah.
And yet that's the whole, that falls under the very human desire for that, control or illusion of control. That's why forecasts and predictions are so popular, right? It gives people a false sense that they know what's going to happen. And then again, I'll tell you, our brains are really interesting things. I always say we're walking around with these quantum computers in our noggins, and we don't have an operating manual.
There's no manual, right?
And so one of the reasons why I urge people to keep written journals, right, is because one of the things that our brains do, which I think evolution thinks is a kindness, it's not a kindness for investors, but it updates our memories. And believe me, I've kept journals since I was 19, and I know this to be true because I've been called a liar in my own handwriting, right? What happens is it updates our memories to make them consistent with our current viewpoint.
Right.
Marry that to hindsight bias, right? Where we
Yeah.
naturally think, well, everybody saw that coming. And then you go back and look at what was being said at the time. Nobody saw that coming.
Exactly.
And then, of course, the media will pick up the one guy out of the 1,000 forecasts, or gal, that wrote the right one and say, genius, let's put them on the air.
Yeah, exactly.
So,
meanwhile, they're always bearish, or they're always bullish, or whatever the case is. Broken rock, clock is right twice a day. Got it. So, no, that's really, really good. I guess question for you, Jim, on that note, if you want to remove the biases from the equation, which is very difficult, if not impossible to do, I understand your point about what you just said about having a model and then having the gumption or the ability to stick to that model. And yours is very time tested and quantitative based. So it doesn't apply to discretionary investor, it applies to the quantitative guy. and finding a system or an approach that works for you and tweaking it a little bit to make it work for you. But how do you speak to or how do you help people overcome those biases that hurt them, so to speak, if they can't be untaught? But you just said you can't learn how to overcome those biases. How do you solve for X right there? If you could speak
Yeah.
to that a little bit.
Boy, I wish I had the definitive solution. I don't.
Okay. Neither
But
do I.
one of the things that we urge a more conventional approach, discretionary investing, is develop a checklist, right?
Mm-hmm.
Marry that to the journal
Mm-hmm.
and go down your checklist and say, did I look at this? Did I look at this? Check it off, right?
Right.
Because the whole checklist thing has pretty good research on it, and most of it's been done in medical situations.
Yep.
But they find that in medical situations where a checklist is used, you have a much lower failure rate and everything
100%.
else.
Yeah.
So write about why you're doing something, right? Because when you go back to it, right or wrong, right, you're going to be able to see what you're thinking. And then we advocate that people understand that don't, as my friend Annie Duke says, don't look at any one outcome. She calls that resulting, right?
Yeah.
So what you want to look at is in aggregate, right? So not the one stock that you want to brag about at the cocktail party,
Right.
nor the one that you don't want anyone to know that you owned.
Right. Right.
But aggregate them all
Mm-hmm.
and say, okay, how am I doing?
Yeah.
And the more you do that, the more you're going to shift your frame of reference, your internal mental frame of reference,
Mm-hmm.
away from individual singular outcomes, because, right, a good process can have a bad outcome.
100%.
And conversely, a
Yeah.
bad process can have a good outcome.
Right.
So people who make their decisions based on outcomes, single outcomes, are not going to be happy over long periods of time.
Well, that's an outcome bias. It's another cognitive bias, right? It's called outcome bias. Yeah.
Yes, that's right.
No, that's really good advice. So you have two main buckets. You said value, and then you have momentum or growth. A few questions are coming to mind, but first, how do you define value? I know value, like beauty, is very subjective,
Yeah.
but in your mind's eye, how do you define value?
So we have as What Works on Wall Street, as I wrote new editions, I took advantage of learning from others, right? So I read a lot of academic pieces, and I just happened upon one that was like, it was about me and What Works on Wall Street. And these guys were saying, we thought that maybe if you combined O'Shaughnessy's price to sales ratio with PE ratio, you'd have better outcomes. And I'm like, that's very clever.
Yeah.
So we started doing that, and we found that even more, when you look at the entire balance sheet from top to bottom, you get the factors that define our value composite. And so the way we define value is a stock that passes through all of these ideas of relative cheapness, right? Based on PE, price to sales, EBITDA to enterprise value, price to free cash flow, et cetera. Because we found that over time, and proviso, we know value has not worked well over the last 10 years.
Understandable.
And okay, you're right. But then I guess our added definition, if you will, is what we talked about earlier. We have other composites that kick stocks out that might be fine if you were only interested in deep value, right? They'd make it in.
Okay.
But we have these earnings quality, financial strength, levels of debt, all of those types of things that we have found lead to really sad outcomes.
Okay.
And so basically our way on the value side is we have two approaches primarily. So for large cap stocks, we found that winnowing down the list by our value composite, and then these other don't buy this stock, financial strength and earnings quality. And then we focus in, for example, with our market leaders value, on stocks with high shareholder yield. For smaller cap and micro cap names, we will actually sort on the value composite.
Okay.
Right. So the ones who are the cheapest
Mhm.
get in the small and micro cap environment.
Mhm.
Very different environments. Large stocks behave differently than small stocks.
Right.
On the growth side, same kind of thing, right? Except we emphasize and often sort on the final momentum composite, which we use several momentum marks.
Indicators. Okay. Yeah.
Yeah, but then we also use the how volatile that momentum was, standard deviation of return, because we found that historically stocks with great 3, 6, 9, 12-month price momentum are really volatile, right? As I said before, but the ones who are super volatile
Mhm.
generally provide less return than the ones that are a little less volatile.
Nice.
So we have that built right into our composite, and we select stocks on the growth side based on that.
So what would be some of the where is that sweet spot from volatility where too much is no good or too little is no good?
You know, I'd have to look, I have the data right in front of me to give you a good answer. But let's say we eliminate the upper several deciles based on volatility.
Got it. And that's just
And,
price
and that
action.
and by the way, that changes continually, right?
Yep.
If you have a very calm market, the upper deciles on volatility are much lower
Right.
than if you have like a crazy market like we had in the beginning of the pandemic, right?
Right.
Woo!
Yep.
And so that's another, but that brings up another really great point, which is it's relative, right? We don't say if it's above X, we will not buy.
Yeah, like if
right?
the stock moves $5 or 5 percentage points or whatever it is. Yeah, that's not how
Yeah,
you're doing it.
we always say relative to what's going on.
Understood. That's really good. So the actual definition, if you were to use, hey, this stock is overvalued if it has a PE above X or undervalued if it has price to sales below X, are there any metrics that you would say that, hey, this is an undervalued stock, or is it still this subjective side of it where beauty is in the eye of the beholder or value is in the eye of the beholder?
So yeah, I mean, we don't do subjective, right? So think of us
That's my
as
question. If
yeah,
that's where,
yeah,
the audience
yeah.
is going to ask me, hey, Adam, how come you didn't ask him?
So think of us as the Vulcans to Dr. McCoy's human.
Right.
And so everything again is relative, right? So if we were going to look just at value,
Mhm.
right, we would say that it's on a continuum, and the decile we are interested in is the cheapest decile.
Okay. Got it.
Okay. And what cheap is depends on the market,
Yeah.
right? So if you've got a market like today where they're pricing things, historically outside of any norm that we've seen,
Right.
it still doesn't defeat our model because our model just ranks. And right, so this is the cheapest 10%, which might look very expensive to an investor from 10 years ago,
Understood.
but relative to today, it's the cheapest decile.
No, that makes perfect sense. So I guess, Jim, next question is, what are some timeless lessons that you haven't already shared that you've learned along the way that you'd like to share with the audience?
Sure. So you are your own worst enemy, and I include myself.
Me
Right?
too.
Anybody who says, "Oh yeah, I see how they do that, but that doesn't affect me," is fooling themselves.
Toast. Yeah.
And it's again human nature, right? Human operating system is we are really good at seeing flaws in others. And there's a great quote by Anthony DeMello, who was kind of a seeker in spirituality and stuff. He was like, if you want to know your own faults, look at what annoys you in other people.
Right. It's really powerful. That is really deep.
So,
Yeah.
so internalizing that is very, very helpful.
Yeah.
And by the way, being really smart, having a high IQ, does not exempt you. As a matter of fact, it makes you more likely,
Yes.
right? Because what are really smart people good at? They're good at narratives. They're good at convincing people. They're good at all those things, right? And so they're going to tell a much better story. Still a story, right? So the second thing would be that know your goals. It's funny because we were joking before we went on the air that we're not going to cover politics, and I joked that we had an event upcoming, and I said, well, let's talk about something uncontroversial like religion.
Right.
But the whole point is, understand what your goals are. A lot of people really don't, right? I've talked to thousands and thousands of people, and it's like, one of the things that I see, and this is no fault of their own, by the way, it's just like, they're not really even aware. What are my goals? For most people,
They're gone.
yeah, but for most people, they have really simple goals.
Yeah.
They want to fund their retirement. They want to be able to give money to their kids or pay for their kids' college. Really simple stuff. And so if you understand that, you're gonna find that process that's better for you than somebody who wants, like, to say, I bought Tesla when it was at 10, or fill in the blank, right?
Right.
And so understand that, and then finally, I guess, understand that even the greatest investors throughout history have totally screwed up. And it's not that they've screwed up, it's how they handled that.
Right.
Right. So Chumbawamba, I get knocked down, but I get up again. Right.
Yeah.
And so that, a lot of people, because of human nature, right, we try to guard ourselves against these failures, right? We don't want other people knowing about them, things
Right.
like that. To me, they're not failures, they're learning opportunities.
Right.
And if you treat them as learning opportunities, you're going to, guess what? You're going to soar way above other people, because, most people don't get that. And then finally, there's a huge difference between understanding something intellectually and understanding it emotionally.
Right.
And I got to tell you, man, if you don't understand it emotionally, you're done.
Yeah.
Because what happens, right? Fear, greed, hope, and ignorance come along. The four horsemen come riding in. And what happens is, guess what? The perceptions that are hitting your perception field bypass Mr. Executive up here, the prefrontal cortex, and they go back to the lizard brain, which is all emotional, fight or flee, right? And what people don't really understand is evolution's pretty cool. It shuts down all of these other things, and
intellectual.
Yep. And it boom, I got to act right now. And historically, that was great, because our forebears, who were wandering around as hunter-gatherers on the plains of Africa, if they saw a bush rustling, they ran away.
That's it.
Right. And so
get that snake out of here.
I joke that we are all descended from cowards, right? Because the bold people went in and they got eaten by the saber-toothed tiger. So, give yourself some room, be kind to yourself, because we're all the same.
100%. Yeah, I love that. The human operating system, I've gone back and studied markets and economies and cycles and blah, blah, blah. You see the stocks change, the bubbles change, the asset classes change, the centuries change, but the one constant's human nature, right? So if you go into a crowded theater, yell fire, you get the same response everywhere, which speaks to your point. And we are all the same. So that's some really, really good lessons you just share with us.
My pleasure.
What are some timeless, I guess the mistakes I was going to ask you next, but I guess you've kind of hit on those. Are there any other mistakes that you see people make either on or off Wall Street that you'd like to share?
So, I mean, look, mistakes are a part of life. And like I just said a moment ago, it's all about how you perceive them, right? And that's like a very stoical attitude, right? The only thing that you control is your own mind.
Yeah.
So if you're watching or reading some horrible thing, right, and you can't do anything about it, investing an ounce of your time and emotion into that is going to be bad for you.
It's a negative ROI is what I say.
It always is.
Yes.
Right. So that's a continual mistake that I see. And believing that you have greater control over things that are so totally out of your control, That's a big mistake, right? Because, you know, you can't. And then finally, this one I don't talk about often, but I've been thinking about it a lot. You can't read other people's minds.
Right.
And so I joke around on Twitter because I say, anyone who responds to one of my tweets with, "So you're saying," I immediately mute.
Right.
Because no, I'm actually not saying that.
Right.
Because normally it goes, "So you're saying," and then they fill in their version of
what they think you're saying.
they are attributing to me, right? And it's, we all do it. Again, I'm not exempting myself. We all do it. And it's good to pause and say, okay, I can't read other people's mind. Another problem that plagues us as people is premature certainty, right? We become prematurely certain about something, and then guess what?
You're wrong.
It gets kicked from your open-minded over to no. I'm now going to seek only information that confirms my priors.
Right.
And that's not good.
Which is confirmation bias, another cognitive bias. Yeah.
And the thing is that try to remain as open-minded as you possibly can, because we can't read minds. We don't know what other people are doing. We should judge them by what they do, not what they say. Right. That's a big one.
Huge.
And because look, we could all get on any social network today, Facebook, Twitter, Instagram, whatever, and just say, I think, you know, and fill in the blank. Right. and if we're not doing anything about what we say we think, we're not doing anything. It's pointless, exactly. Right? And so, but I'm also like what I call a pragmatic optimist, right? I would never short the US because look, the politics can get all screwy, and it has, but I am long the US, the people of the United States, and the people who want to come here. There's a couple of really great books about how the DNA, the very DNA of America, is different than virtually every other country. Why? Because everybody who came here, for the most part, except for indigenous Americans, were risk takers.
Yes.
I mean, what kind of person wakes up in the morning in, let's say, Norwegia or Norway, sorry, and says, huh, you know what? I don't have any money. I'm going to jump on that ship, go and steer it. I'm going to go over to America. I'm going to leave my family behind. And
don't speak the language, no money, no internet, no phones, nothing. Just see you later.
So the profile of risk-seeking behavior is very different than non-risk seeking. Our country happens to be made up of people who are descendants who are massive risk takers. But I also, another one of my little soapboxes that I'm on that people get mad at me for, but I keep on it. It's like, you know, one of the biggest advantages the United States has, in my opinion, is that the smartest people in the world want to live and work here.
Right.
We should let them.
Yeah.
You know, half of Silicon Valley successful companies founded by immigrants.
Right.
You know, some of the hardest working people I've ever had the pleasure of talking with and interacting with, immigrants. And because they're kind of like showing, I can do this, right?
Yeah.
And so we should take a maximum advantage of that. And so, you know, there's so much that we need to learn, and you know, I'm still learning every day.
So you're saying
boom. That would be fantastic, right? If you ended this podcast on you saying that and then done.
Mic drop, right? I love
fantastic. That would be fantastic.
So I had to just throw that in there.
I love it. I love it.
Warren Buffett has the exact same point. He calls it the great American tailwind, right? Where it's, you know, America's going. I couldn't agree more. So I guess, Jim, you've been very generous with your time, your knowledge, your expertise, and everything. Just a few final questions here. What advice would you give to your 30-year-old self or younger people listening or watching today?
So let's do with younger people, because luckily I had already figured out parts of what I'm going to give as advice when I was 30. Read everything. And I mean everything. Some of the greatest insights that I've had, like if you go and look at the threads I do on Twitter, right?
Mhm.
The Tao Te Ching by Lao Tzu, which is,
Yeah.
an ancient text from China.
Fantastic. Yeah.
Boy, they got a lot of good stuff to say about investing.
Mhm.
Read psychology, read biology, understand evolution, because these are the things that are really pulling the trigger,
Mhm.
right? I, I'm not saying don't read finance. Do. I read every major financial academic and practitioner paper that comes out. Guys like Michael Mauboussin, amazing. Read everything he writes.
Fantastic. Yeah.
And by the way, they're all on Twitter
They are.
and they get announced. So start following them. The other bit of advice that I would give is understand, and this I would also give my younger self, because when I was 30, was a proselytizer and believed my way was the only way. That's not true.
Right.
And you need to understand that there's a lot going on with your average person.
Mhm.
You can't read their mind.
Right.
And if you really get to understand that, you're going to be a better person, I think, because
Mhm.
you're going to give people more room. And that's good, because I think we're kind of going into a golden age, and people laugh at this too. But I think that Twitter is going to emerge, and Twitter specifically,
Yeah.
despite their best efforts to make this not happen,
Right.
I think that it's going to emerge as the first diversified global intelligence network.
Mhm.
And so, but there's always a but, right?
Of course. Yeah.
But it's the 80-20 rule here.
Yeah.
There's a lot of noise,
Garbage. Yeah.
and you've got to get good at curating who you're following.
Right.
And if you do that and you take it a step further and call them, get to know them,
Yeah.
meet them.
Yeah.
Some of my better friends, honestly, I met through Twitter.
Look, we're here now because of Twitter. I
Exactly.
reached out Twitter. Yeah.
And so follow right now the young people. My God, it's like I was talking to my son, who's the CEO of OSAM, right?
Mhm.
And God, I love young people
Yeah.
because they really understand. So Zoomers, not millennials, but Zoomers, right?
Right.
So
Right.
people like 24 and younger,
Yeah.
they are native to the digital world.
Yeah. They grew
And
up in it.
yeah,
Yeah.
when I see some of the things these kids can do, and by the way, that's the last thing I'll say. Please, for the love of God, do not bash people by their generation.
It's so bad.
I mean, right? Okay, boomer. I think it's funny. So
Right.
I actually recorded my grandson saying it to me, and then somebody made a gif of it. And so don't paint with a broad brush,
Mhm.
right? Judge people by what they do and who they are, by their ideas.
Right.
And it's equally bad for boomers to be like, oh, those millennials, or oh, those Zoomers.
Gen Z.
Stop.
Yeah.
Because guess what? I had the pleasure of meeting several Navy SEALs, and the last one I met was a big deal in the Navy SEALs. And guess what? He was a millennial. And this guy, boy, come the Armageddon, I want him in my foxhole.
Exactly.
So don't paint with a broad brush. And we've, by the way, something we've done all throughout human history.
Yeah.
Oh, that generation.
Yeah.
Right. And
Exactly.
don't do that.
It's so dumb.
Look at what people are saying, not grouping them by their age or whatever.
Yeah, no, that makes perfect sense. And to your earlier point too about look at what people do, not what they say with the investing. It's like, okay, the guy comes on, talks his book, and he could be selling or whatever the case may be. So focus on the actions, not anything else. Well, Jim, this has been super, super fun. Thank you so much for taking the time to talk today and sharing your wisdom, your intelligence, and all the fun stuff in between. And hopefully we'll see you on again soon.
Fantastic, Adam. Thank you very much. This was a lot of fun.
Thank you.